Everybody, welcome to Yahoo Finance Live. I'm Dave Briggs along with Shauna Smith. Let's get you up to speed quickly on the market action. Stocks are trading lower as we head into the final hour of trading. Big action will be coming after market close. First, we'll get Salesforce reporting its fourth quarter earnings after the bell. At least 5 different activist investors have taken stakes in that company, putting pressure on CEO Mark Benioff to deliver some results. We'll bring you those numbers as soon as they're released, Sean.
And then there is Tesla. The EV maker is holding its investor day. CEO Elon Musk tweeting that he will be unveiling, quote, Master Plan 3, the path to a fully sustainable energy future for Earth. Now, analysts are going to be watching for any updates to the Model 3 and Model Y. We will also be looking for any updates to the long-awaited Cybertruck.
Okay, but first let's get you up to speed on housing. With loads of data coming in recent weeks, really paints a picture of a market that may not have seen the worst of it after all. We want to focus in on 3 data points from this week in reverse. Okay, mortgage demand, Case-Shiller, and pending home sales. Up first, mortgage demand falling for the 3rd straight week, according to the Mortgage Bankers Association. Demand dropping to a 28-year low. It's down 6% from just last week. Overall, you see volume down 44%. Below the same point last year. This all is really a result of mortgage rates also rising 3 consecutive weeks to 6.5% on the average 30-year fixed. That's the highest point since November. Rates were also 3.89 1 year ago. Up next, home prices decreasing slightly in December, according to the S&P CoreLogic Case-Shiller Home Price Index. The national composite falling 0.8% month over month as high mortgage rates help slow price gains. But those price gains are still too high. Home prices as of December 2022 still up 5.8% year over year. And that is important. Still up no matter what you're hearing in these last couple of months. And finally, pending home sales. The index increasing for the 2nd consecutive month, up 8.1% from December. That's the largest jump since June 2020. Despite this bump, pending home transactions are down 24% year over year. The backdrop of all this is not Fed hikes, despite what many urge you to believe. It's really the 10-year. That eclipsed 4% earlier today, its highest level since November. It was up more than 50 basis points in February alone. As we start March, most economists felt the worst was behind us in relation to housing. That may not be the case, Shauna. I was with them. I too thought it was all uphill from here because the data really was reflecting that. The problem is rates feel like we're headed back to 7%. I hope they're not, but we thought we were going to 5 before 7, and now we're on the up.
Yeah, I think you and I both shared in that optimism there, hoping that maybe the worst was behind us. It's all going to depend on that mortgage rate number. We heard that from Mark Zandi from Moody's yesterday when he was talking about what to expect when it comes to housing, more specifically what he's expecting to see when it comes to home prices. And he was saying we have further to go in terms of the drop that we need to see in home prices. He was laying out the scenario. If there's no recession, if mortgage rates stay within the 6 to 7% range, don't go back above that 7% number, we will see a 10% peak to trough decline in prices. So if you take that into consideration, we're about a fifth of a way there. The fact that we've dropped about 2 percentage points there already. Morgan Stanley tends to agree with him, but they were saying, though, if mortgage rates do fall more than expected, we don't necessarily need to see or will likely see that big of a drop in home prices. It might look more like that 5% number that we had talked about in the past.
Let's just be clear. I do not think home prices are going to collapse. I still think a low single-digit drop, and they'll still be higher than they were year over year. But a couple of things anecdotally. I'm talking to realtors who are saying, hey, they feel the spring season. This is California, New York, Connecticut, they're feeling spring season. They're feeling inventory start to open up. Look at home builders. Toll Brothers is up 17% this year. KB Homes is up 8.5% this year. Lennar is up 5% this year. That is well outperforming the market. So there is certainly some optimism. It just feels like, again, there are some bumpy times ahead of us the next couple of months. But again, watch the 10-year. not the Fed. Watch the 10-year.
Yeah, and the 10-year breaking above that 4%, certainly getting everyone's attention. Well, some of that drive in that 10-year today was what we heard from a number of Fed officials. We heard from Atlanta Fed President Raphael Bostic, also Minneapolis, Fed President Neil Kashkari today, both discussing the stickiness of inflation and what that means for Fed policy. Bostic writing in an essay, quote, "I think we will need to raise the federal funds rate to between 5 and 5.25% and leave it there until well into 2024. We also heard similar hawkish rhetoric from the Fed's Kashkari earlier today.
So there's a lot of attention to the next meeting in March. Is it going to be 25 or is it going to be 50? I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's much more important than whether it's 25 or 50 is what we signal in what's called the dot plot.
Certainly that has been a focus, the dot plot here most recently. So 50 basis points looks like it could be back on the table. We want to bring in Aditya Bave, a senior economist at Bank of America. Aditya, great to see you here. So just first, your reaction to what we heard from Bostic and also what we heard from Kashkari earlier today, that hawkish rhetoric once again.
Good afternoon. Thanks for having me. I think we split the difference between the two. We actually have 3 more 25 basis point hikes in our forecast. That would get the terminal rate to 5.25 to 5.5%. So that's a little bit higher than what Bostic has, but we're not yet ready to concede that the Fed's going to go 50 in March. So maybe a little bit less hawkish than Kashkari.
And of those comments, what really stood out to you the most? What surprised you? I think the one thing that stood out to me, Kashkari saying the bigger risk is not doing enough. They're not afraid to over-tighten. And, that's something we've heard from Jerome Powell from the very beginning. If they're going to make a mistake, it's going to be on the over-tightening side of the Fed statements today. What stood out to you?
To be honest, none of this was particularly surprising. I think the Fed understands now that inflation is fundamentally a demand problem. They can't hope for immaculate disinflation, as we like to call it, essentially help from the supply side, getting us all the way back to 2% inflation. That doesn't seem like it's going to happen. And as long as inflation is a demand problem and demand shows signs of being sticky, persistent, then the Fed has to keep tightening.
So then, Aditya, that begs the question, how high will rates have to stay in terms of the timeline of that higher for longer, something we've been talking about because of that stickiness of inflation? What are you predicting?
We have the Fed remaining on hold till March of next year, but I think it's better to think about the timing of Fed cuts more in terms of what it would take for the Fed to cut, so thresholds rather than a calendar date, right? So I think the Fed would probably need to see 3-month inflation coming in around 2%, particularly on the core. And the only way that probably happens again is that the Fed finds the point of pain for the consumer. And we seem to be some ways away from that. So our base case, again, has the economy going into a recession in the third quarter of this year. And in our view, that will help bring inflation back down to much closer to 2% by March of next year. But if you don't get that recession, if the consumer remains resilient, then the Fed will have to hike further and probably remain on hold longer.
And getting back to your statement about it being primarily a demand problem, what do you think needs to happen with the labor market in order to bring that inflation number near the target?
The labor market has to slow down. We know that job and income gains are a big driver of consumer spending, probably more important than some of the other stuff that gets discussed around consumer leverage and excess savings and so on. So the labor market has to slow down. We know that the break-even rate of job creation to keep the labor market in equilibrium is around 50 to 100,000 jobs per month. Well, over the last 6 months, we've been averaging 350,000 jobs per month. So we've got some ways to go in terms of cooling off the labor market.
Yeah, and we'll get another read on the labor market next Friday when we get February's numbers. What are you expected to see there?
We don't have a forecast just yet, but we don't think it's going to look like 517,000. I think there's good reasons to believe that last month's number had a significant noise component in it related to favorable weather, related to labor hoarding. So again, we don't have a forecast, but I would expect something more like the November, December numbers in the range of 200 to 300 rather than a 500,000 print again.
Yeah, I think that number shocked a lot of people. Aditya Bhave, great to have you, Bank of America senior U.S. economist. All right, we are just getting started here on Yahoo Finance Live. Coming up, the wave of layoffs continuing. GM reportedly cutting roughly 500 jobs in an effort to boost profits. We will break down what's happening with automakers. Then Dime Brands earnings CEO John Payton stopping by to weigh in on the state of the consumer and also discuss the future of food and beverage industry. It's another busy day on the earnings front. We've got Salesforce, Snowflake, Okta, Plug, and Splunk all set to report after the bell. We'll bring those numbers to you as soon as they are released. Don't go anywhere. More warning signs on the consumer coming from retail companies today. Lowe's and Kohl's both reiterating that 2023 is shaping up to be a challenging year. But there still might be some opportunities within consumer stocks. UBS out today, upgrading Procter & Gamble to buy, raising its price target to $163. We have the analyst behind that call, Pete Grom, UBS U.S. Household and Personal Care Analyst, here with us. Pete, great to see you here. So you're bullish on Procter & Gamble now, making the case that the recent underperformance is unwarranted. Why?
Yeah, first off, thank you so much for having me today. It's great to be here. So yes, we think the recent underperformance is a bit unwarranted. You know, first and foremost, some of the underperformance has been related to some of the unwind and some of the defensive, sectors we've seen year to date, like consumer staples. But we think one of the bigger concerns has been around the lack of positive estimate revisions. Positive estimate revisions have been a prerequisite for, consumer staple stocks to work this year. And we think some of the concerns around Procter & Gamble and the lack of revisions are somewhat misplaced, as we think there's an inflection on the horizon looking out to fiscal 24. We see a path to strong mid-single-digit organic revenue growth. This is predicated on, low single-digit underlying consumption growth, as Procter has exposure to categories that are growing and geographies that are going to see higher per capita consumption. We also see there's, room for share gains, as the company's been able to do that over the past few years. We also think there's going to still be some room for pricing, albeit somewhat limited through premiumization. And we also think idiosyncratic benefits like China reopening are also going to benefit. So Procter & Gamble kind of checks all these buckets, and we're kind of layering in a balanced approach in terms of gross margin expansion, but also reinvestment. We see a path to high single-digit EPS growth looking out to next year.
Peter, anything you see from Walmart or Target in terms of the consumer beginning to hold back a little bit and caution from their CEOs give you a bit of caution on P&G and their pricing power?
It's a great question. I think right now, Procter & Gamble, operates in daily use categories. And in daily use categories, brands matter, performance matters. And so, while list pricing might be harder to take as we move into the back half of the year this year, there's other revenue growth management drivers that companies are able to taxes they can kind of take on here. I mean, I think first and foremost is just around innovation. If you provide a product that is going to provide a reason for the consumer to trade up, that is going to not only drive category growth and share gains, but it also provides, stronger pricing or mix. So not necessarily any sort of signs right at this point that would point to the categories necessarily slowing or that the consumer is holding back, just given the daily use nature of these categories.
Yeah, and Pete, you've got a great look on the consumer with your coverage list here. You have PepsiCo, Boston Beer, Newell Brands, Monster Beverage, just to name a few. Of the weakness, though, that you are seeing, where is it?
Discretionary items, appliances. So companies like Newell have seen much weaker performance. Even the Yetis of the world have seen weaker performance. These are products that or categories that saw outsized growth during the pandemic, both from a result of consumer behavior or people staying at home more, but as well as stimulus, right? And so a lot of these categories maybe typically grew 2 to 3% per year, and from 2020 to 2021, they were seeing mid to high single-digit growth, and the consumer is pulling back on purchases of these items, not only because of broader macro weaknesses, but also simply because there's just less need to purchase some of these appliances on an annual basis.
But with Pepsi in their Q4, what we saw is largely the price hikes are what sustained the profits, but the volume and the demand seemed to fall. Is there a correlation there with P&G?
I mean, more broadly, pricings are moving up well above historical norms. You're talking, in certain cases, high single-digit, low double-digit price increases. And there are sticker shocks. The consumer is, holding back in terms of the amount of product that they purchase. But what I would say is the elasticities are holding up better than we would have thought. So, at the end of the day, I think the consumer, and this was alluded to on your prior segment, with unemployment still relatively low, the consumer is still in a pretty okay spot to absorb some of these price increases for some of these everyday use categories.
All right, Peter Grom, really appreciate that. Good stuff. Thank you. All right, we're less than an hour away from Tesla's big anticipated Investor Day, where CEO Elon Musk is set to unveil what he's called the EV maker's Master Plan 3. Here with some insights on what we can expect out of Austin, Texas later this afternoon is Yahoo Finance senior autos reporter Praz Subramanian. It's about Austin, Texas. It's also about Mexico today, which has been an interesting surprise from Elon. What's your biggest question? What do you think is going to be unveiled?
It's going to be this whole grand unifying theory of Tesla, right? What does Musk see as, cars, space, rockets, AI even, right? Robots. But what I'm mostly interested in is I want to see this Gen 3 platform, the new car, right? This is going to round out that whole product portfolio, right? You have the SUV, you got the Model 3, you got the high-end Model S, the pickup coming, right? But what's on the cheaper end for normal everyday Americans is probably that Gen 3 platform, maybe a small crossover or like a hatchback. So I'm really interested to see that and also hear about solar and batteries. What are they going to do with getting that clean energy and using that to power the cars? And what do you do with that power once you get it? How do you store it? So I think that's all kind of what we want to hear about.
How much of it do you think is going to be focused on just Elon Musk himself making the case to shareholders that maybe they don't need to be too worried about his dealings with Twitter, how he is dividing his time? Because that certainly has been an overhang on the stock, although it seems like we are slowly moving away from that narrative.
When they announced this Tesla Investor Day, it was back in January, around the time that people were considered considering where is Musk? Is he focusing a lot of his time on Tesla? And I honestly think they actually announced that meeting just to show that he's still involved, that he's still a big part of the. I mean, I'm just throwing it out there, but it really sort of coincided with that, and then also the stock kind of going up almost 70% since then. So I think it's a huge part of it is Elon Musk's sort of vision and also his presence at Tesla. I think is a huge part of this. Why they're having this meeting.
I'm eagerly awaiting the cowboy hat's return. You know me, I want to see if the cowboy hat is back. I'm not as eager about the Cybertruck, though there has been a lot of sightings lately out there going around on Instagram and Twitter. Can there be anything new, an actual hard date on the Cybertruck? Do we expect anything in that capacity?
You know, they said back half of this year. At some point, they would begin production, possibly in the fall or late summer. I think maybe we might get a hard date on that. Maybe we might see an actual close to production prototype or model there. I've seen people are actually tweeting out pictures of the Cybertruck. I've seen on Twitter. It's got two, not the bench in the front now. It's two individual seats, a rounded yoke type of steering wheel. Potentially a closing. See that hatch closing the back. They've showed that before.
I saw solar panels go up from that as well.
Yeah, we'll see if that actually is the case. But anyway, I think you're right. I think we'll see some more bits and pieces of what this thing could actually look like when it comes out. When?
There's only two schools of thought on this. It's up or down. Which are you?
I think they're going to.
Would you drive it?
Own it or drive it?
Would you want to drive that around town?
Yeah, why not? I wouldn't buy
that
it, but
does not sound convincing. All right,
I'm
let it go.
not on board.
You know where I am.
With it. No, yeah, I don't know. It's just.
RoboCop.
I'll drive anything.
The car of the future. Maybe in 30 years, we'll all be driving something that looks exactly like that. It's been a busy day, really, in your wheelhouse when it comes to automakers. We also got a big announcement from GM laying off several hundred workers, something that executives had said that they wouldn't do or weren't likely to do in the past. What do you know about this?
Yeah, it's kind of interesting. They said in the last earnings call, CFO and Mary Barra, CEO, said they were not going to lay anyone off. And they're saying this isn't a layoff. This is just a quote, low performance.
A long vacation,
performance calibration is what they're calling it. So this came after their reviews, I guess, and they're saying, hey, we're letting go some people, about 100 people. It's less than 1% of the salary workforce. So they're couching it as that, but it looks like a layoff to everyone else on the outside world.
Is this something that they've done in the past, do you know?
Not that I know of in terms of like every day, normal attrition and kind of getting rid of low performers. So they're saying that's what's happening, but look at Ford. Almost 4,000 layoffs in Europe they're going to do. And then even Stellantis, they're idling a plant in Belvidere, Illinois, where they build the Cherokee. They're idling that plant. That's almost over 1,500 workers that would potentially lose their jobs. So it's not as bad as other places, but it's happening.
Ford stock up about 2%, GM about flat on the day. Pras, thank you. Good to see you, my friend. Okay, before we head to break, let's take a look at cryptocurrencies. Bitcoin extending gains for 2023, trading above 23,000 on the first day of March. Could it go higher? Take a look at what might be ahead for the digital coin next. Investors piling out of Binance coin with more than $6 billion of outflows over the past month. David Hollerith here to discuss what is happening here, my man.
Dave, so 2 weeks ago, the US-based crypto trust company Paxos, which creates and issues the Binance USD stablecoin, the stablecoin you're talking about, was ordered to stop creating new versions of the token by New York regulators. And since then, we've seen about $6 billion fall from the market cap of this coin. A little more than half of that total has flowed into two larger stablecoins, Tether and Circle's USDC. So prior to the regulatory crackdown, Binance USD was the third largest stablecoin. But this is sort of the beginning not the beginning. This is sort of the latest of what's been a series of sort of kerfuffles and financial sort of questions that have been thrown towards Binance in the wake of FTX's collapse. There's also been this Forbes article that came out on Monday that drew attention to the fact that Binance may be moving assets the assets that support stablecoins linked to this stablecoin, which are also known as B tokens. They've been moving those sort of outside of the exchange's wallets and to other parties, including trading firms, which also include Alameda Research. So there's a lot of questions about that transaction flow and what it could mean for customers' assets. And Binance has rebuked a lot of these charges. Their statements have been mixed, but more or less they've said that the report has been a misunderstanding of blockchain data. Now, while it sort of remains to be seen what is correct, the CSO of Binance, or shortly after Paxos experienced this crackdown, had said that that regardless of how the exchange keeps cryptocurrency in wallets, it keeps a separate ledger for corporate transactions or corporate money and customer money, but it's really not been made clear whether or not that's actually being divided in practice and how they keep the money in wallets. And if what Forbes is sort of alleging is true and backing, I will say, with blockchain data, it would seem that at least for a period in late August, Binance did move funds that were supposed to back a few of its stable coins to trading firms, which would mean the company was lending and not necessarily backing its assets one for one, as they have said they've been doing. But again, this is all something that we're going to continue to watch as it unfolds.
We certainly will. And David, while we have you, Bitcoin, let's talk about the price that we have seen, the rally that we have seen since the start of the year. You're looking at Bitcoin up just over 40% since January 1st. What do you make of this massive rally that we've seen? And we're starting a new month today, first day of March, enough for that momentum to continue.
Yeah, January was momentum fueled for cryptocurrencies. And through February, we actually saw the rally fizzle out. Cryptocurrencies in general ended yesterday, the end of February, flat. And while volatility has fizzled, traders are still piling into the crypto options market. And they have concentrated bets, according to the data from platform Amber Data, of Bitcoin hitting $30,000. And that's the highest concentration, although there's a lot of bets that have been placed between $25,000 and $30,000. And $25,000, of course, is sort of the price that traders have been looking for Bitcoin to rally past. It did breach that price point in February briefly, but that's kind of been the point of contention here. And the expiration date for options right now, the highest amount is set for March 31st. So unless the price goes higher before then, we could expect a large liquidation. But that being said, it looks like because there's little resistance in between 25 and 30, if the price does get a momentum rally this month above 26 or something like that, we could very easily see 30.
All right, David Hollerith, always great to have you there. It's certainly been incredible watching the price action as of late when it comes to crypto and Bitcoin more specifically. We'll see you soon. All right, well, coming up, the fate of Novavax shares plunging today after the company raised some questions about the future of its business. We've got the details for you when we come back. Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Novavax, Rivian, and MSG. Let's start off with Novavax. We're looking at a sell-off today after the company warned that it's facing serious financial challenges. And how serious? Warning that it actually might not survive. You're looking at losses of about 26% today, trading at levels last seen before the start of the pandemic. A very far cry, obviously, from that all-time high, but even from the 52-week high of $91 a share. Now, Novavax is certainly bleeding cash, losing $182 million in its most recent quarter, losing a total of $658 million for all of 2022. Now, since the start of the pandemic, Novavax has delivered just over 1 million doses of its COVID vaccine. That's compared to about 400 million from Moderna and 650 million from Pfizer. B. Riley downgrading the stock to neutral, cutting its price target to a street low of $10 a share, citing those critical challenges facing Novavax. Lots of questions about the potential liquidity, what that future looks like, and we're seeing that reflected in the stock today, but might not survive. It's getting serious there.
Yeah, I mean, you look at the price of Novavax, like you said, Shauna, it's back to pre-pandemic levels. And when you think back to pre-pandemic and what Novavax was as a company, they hadn't brought a vaccine to market prior to COVID-19, right? And I think that's an important thing to remember here when we think about the company kind of coming full circle. I mean, the federal stimulus of buying COVID-19 vaccines is just ending. And I think that they're sort of seeing where that puts them, obviously, significantly, as they have been pretty much the entire time here, behind Moderna, behind Pfizer, and I don't really see a great path forward here, Dave.
No, I don't either. And their CEO says the company needs to do 3 things: deliver a competitive product for the upcoming vaccination season, 1, cut spending, 2, and number 3, find ways to boost sales beyond the vaccine alone. That is 1, 2, and 3. Just find a product beyond the vaccine. You gotta pivot. They are woefully slow to turn this ship around and find a new product. Not looking like.
And finding a new product costs more money, and people are already worried about the cost.
Yeah.
Hundreds of millions, if not billions of dollars in that space. Yeah.
Speaking of other stocks not doing well today, let's take a look at Rivian, sliding as the company's 2023 production forecast came in about 20% lower than Wall Street's expectations. But another key metric here, guys, I want to focus on is the electric vehicle maker likely isn't expected to lower prices. Now, at least for now, Tesla and Ford have already cut prices of their EVs this year, but Rivian CEO RJ Scaringe points to the class Rivian is competing in when explaining why he has no plans to cut prices. Scaringe says the R1 product line is their flagship product line and comparable to three-row SUVs and three-row pickups. He noted in the company's earnings call, Rivian made pricing adjustments earlier in 2022, and they, quote, feel confident in the value proposition of what we're delivering at our pricing levels today. And the reason I highlight this, guys, is I think it's one of the more interesting stories when we talk about the EV space overall is the price cuts, right? We saw investors and really consumers react positively to Tesla's price cuts. It seems like Ford got some positive reaction to their price cuts as well. Rivian is obviously a different consumer. We're talking, I think it's 70 grand to even get into the door with this car, but still no price cuts. I thought was interesting to hear from the call.
I think it's vastly different consumer. I don't think their problem is the price. Their problem is largely production. They had another recall today, 12,700 vehicles from the 2022 models. Our friend Dan Ives over at Wedbush cut the price target from 37 to 25. His primary concern was not the production, it was really the cash flow. He said a cap raise at this point is out of the question. He's concerned they don't have enough money to last, Shauna.
Yeah, and I think those are all very, very valid challenges here, certainly headwinds for the stock. And I think that's why the stock is under so much pressure and why it really has been in almost this holding period as we try to figure out what exactly the future looks like for this company. The bottlenecks, the supply chain issues that have plagued Rivian now for so long. The biggest factor here going into this report, I think really showing that those problems are very alive with Rivian right now, and they have a ways to go in order to solve them.
We'll tell you, there was a customer review out from J.D. Power. Overwhelmingly, people gave better reviews to Rivian than Tesla.
Yeah.
And it wasn't even close.
That surprised me.
Check it out. My play is Madison Square Garden, MSG, launching a streaming service for the Knicks, the NHL's New York Rangers, the New Jersey Devils, and the Buffalo Sabres. The service is set to launch this summer and cost $30 a month or $310 a year. MSG Plus will only be available in the region that already carries its MSG networks on cable TV. And that's a real sticking point there. Traditional TV subscribers will also get access to MSG Plus for free. Now, last year, New England Sports Network, or NESN as you might know it, launched its own similarly priced streaming service for the Red Sox and Boston Bruins. This, though, on the heels of reports that Diamond Sports Group is on the verge of bankruptcy. They broadcast games for 42 teams across Major League Baseball, the NBA, and the NHL. Also, Warner Brothers Discovery also reportedly looking to exit the regional sports networks. MSG largely flat today, up 6% though. This year, on reports, CEO and Chairman James Dolan could sell a portion of the Knicks or Rangers. Very interesting to see what's happening with sports valuations. At the same time, the regional television network system appears to be crumbling because the valuations for these teams are skyrocketing and their television outlets locally are in deep trouble. It is a really interesting dynamic.
It certainly is an interesting dynamic. And Josh, I know you've done a lot of work on this just in terms of the return on investment that people get when they do buy, when they do invest in sports teams. If in fact Dolan does decide to go that route, the value of the Knicks clearly will be very interesting to watch given the fact that valuations have ballooned so much. We had the news this week, Mark Lazary selling his stake that would value that franchise $3.5 billion. It's crazy.
For a
when
basketball
you take
team
into
in
account
Milwaukee.
Exactly.
Milwaukee.
And then we're talking about
Wisconsin, but
the
Milwaukee.
Knicks with New York. So this number could potentially be, I think, crazier than maybe some are anticipating, at least up until this point.
Really, what they need to focus on here is they have great fans, right? We know fans are loyal. We know fans want to watch games. We know that from broadcast ratings and things like that. $30 a month for MSG is just too much for me. Yep. I'm a streamer myself. I love sports. I think it's $6 a month for ESPN Plus. You don't pay a lot of money for a lot of the other streaming services. $30 is a big, big bite. And I think it's a little bit of sticker shock here. I know that happened with NESN in New England, and I think that might happen
Netflix?
Here. Double
that's hard to
Netflix
justify.
for 10
Very
games
hard
probably.
to
10 games
In
a month.
particular, if you're in California and a displaced New Yorker, you can't get it. You can only
Right.
get it here, which complicates that price point.
Yeah, they need to cut it by half, maybe even a third, and they'll be getting the numbers. Yeah, we'll see. But then the investment might not make sense. All right, well, coming up, active ETFs doing much better this year than last. We will tell you why next. And be sure to tune in tomorrow. Our very own Brian Sazi will be speaking with Salesforce CEO Mark Benioff about the company's Q4 results that we are expecting after the bell today. You're not going to want to miss that. We'll be right back. If you're looking to invest in the stock market and you don't want to buy a specific stock, you may turn to a mutual fund or an ETF, an exchange-traded fund. Now, the two share many similar characteristics. They both represent a basket of stocks or bonds, and as a result, are both typically viewed as less risky than when you choose to invest in a single stock. Both are managed by fund managers, but that's about where some of those similarities stop. Mutual funds have been around since 1920s. ETFs, they're relatively new in comparison. The first SPDR S&P 500 ETF, ticker SPY, that launched in January of '93. So here's the advantage over mutual funds when it comes to ETFs. ETFs can be bought and sold throughout the trading day compared to mutual funds, which can only be purchased at the end of the trading day. There are two main types of ETFs that we want to talk about, active and passive. So passive ETFs, they typically track an index here and the portfolio is updated periodically. On the flip side, you have active ETFs, and like their name implies, actively managed by their investment managers. As a result, investing in active ETFs has had a slightly more human touch. And so far this year, seems like that is what more and more investors are wanting to see. More investors are pouring their money into active ETFs this year than they did last year in 2022. So let's talk about all of this. For that, we want to bring in Dave Nadig. He's VettaFi's financial futurist for this week's ETF report brought to you by Invesco QQQ. And Dave, I think there's lots of questions about the rising popularity of these active ETFs. What's driving that? What do you think?
Well, historically, this has been an index-only business, right? You mentioned the first ETFs were all index-based. We didn't really get any active ETFs until PIMCO brought out BOND, their active bond ETF. And even then, most of the assets just sat there for about 10 years. It's really only been in the last year and a half or so that we've seen any real interest in active ETFs. This year so far, we're looking at about close to 40% of the flows. Last year was already a big year. We got up to close to 14% of the flows. That was already the biggest year we'd ever seen for active, up from about, I think, 8 or 9% the year before. So clearly this is a story of investors slowly coming to this realization that active may have a place in their portfolio.
Why? Why the transition?
Well, a couple things. One is we just had a big down market. So when you have a big down market, two things happen. One is people lose their conviction a little bit, right? They may have been in an index strategy. They just saw themselves take a haircut. Maybe now they want somebody minding the store. That's a phrase we hear all the time from financial advisors. I want somebody minding the store when the interest rates go crazy or whatever. So there's a piece of that. The other big thing is we just went through a big tax loss harvesting season. A lot of folks who were in maybe underperforming funds, whether they were active or passively managed mutual fund or ETF, took the opportunity to sell and book a loss. When they were coming back into the market in 2023, increasingly in the equity space in particular, we've seen a real interest in finding either individual portfolio managers or teams of portfolio managers to run that money. Whether or not it's going to work, you never know.
Dave, the ETFs that are attracting the most amount of money when it comes to the active ETFs, what are they and why do you think those ones in particular?
So they're actually fairly traditional stock picking active managers. Two that I'd highlight would be CGGR from the Capital Group, Growth Fund of America. Most folks know that fund by name. CGGR has been beating its core benchmark, which would be the S&P 500 by about, I think about 4 or 5% so far this year already, just in the last few weeks, few months. And as a result, it's pulled in a couple $100 million, while the complex of S&P 500 index ETFs has actually seen $10 billion flow out in just 8 weeks. So clearly that's a real reallocation we're seeing.
Given the language from the Fed, we heard some officials talking today about, a 25 could be a 50, holding until middle of 24. Does that lend itself to one or the other?
Well, I think it lends itself for people questioning their allocations. And anytime that happens, there's a couple, like I said, there are a couple things that happens. One is that choice of that conviction shakes. But the other is you start looking for what could I have done better, right? If rates are now going to be 50 or 75 bips and I don't know what to do about that, finding a seasoned portfolio management team at least may make you sleep better at night. Now, historically, we know the track record for active as a class is not actually that great. Last year was better than many years in the past, but still only about 45% of active managers managed to beat their benchmark last year, and that was a great year.
Dave Noddick, excellent information, sir, as always. Great to have you in studio.
Thanks for having me.
Thank you, my friend. All right, coming up, the days of endless scrolling on TikTok might be over for some. We'll tell you why screen time is being limited for young users. Next. Endless scrolling on TikTok could soon be a thing of the past. The social media platform announcing today that every user under 18 will eventually have their accounts default to a 1-hour daily screen time limit. My kids burned through that before breakfast. Yahoo Finance tech editor Dan Howley is here. Dan, and I am very skeptical of this actually having any impact. Tell us about it.
Yeah, so the big deal here, Dave, is that rather than having to opt into a kind of time limit for how often you can use TikTok throughout the day, it's something that's already set up. So it's adding friction where a user would have to enter a passcode and then continue scrolling. Now, TikTok is addictive. I had to delete it from my phone because I would just be scrolling through it nonstop. And you know, the idea that you're adding this limit means that, yes, it will give people a semblance of control, though, you know, an hour of scrolling is still an hour that you could have been doing something else. It is, you know, better than 4 hours of scrolling, I guess. I think the question here is, you know, how many people will actually, or how many young people will actually continue and stick with that 1 hour time limit versus just tapping in whatever the passcode is and then continuing merrily along. So, you know, I do question whether it is going to be super effective, but this is a way for TikTok to try to placate parents and give itself a better look, considering all the pressure that it's coming from the Congress.
Yeah, Dan, I wanted to ask you that. How much of this do you think is really just a PR stunt from TikTok trying to get ahead of some of that criticism that's out there? And how does this compare to some of the limitations or some of the controls that have been placed from some of the social media giants here in the U.S. when it comes to Facebook and Instagram?
Yeah, I do think it's a positive. It's not necessarily, you know, a huge change, though, right? Sure, it's big that it's for people under 18. That's their main demographic. That's the group of people that are most associated with TikTok. But at the same time, if you can just press a button, a few buttons to get your passcode in, or even disable this entirely, well, then it kind of defeats the purpose. I do, you know, obviously think that it is in line with what we've seen from other social media platforms. Instagram in particular, you know, Meta was criticized because Instagram, there was that huge blow up where we had the whistleblower come out and say that the company knew that it had a negative impact on young kids, especially young girls' body image and mental health. They added some features to limit the ability for you to use Instagram. If you were under 16, it would default you to the strictest setting. So, you know, we've seen social media companies do this before, but, you know, at the same time, this isn't going to be the cure-all for their problems in Congress. And they're clearly aware of that. Just because they're limiting how often teens can scroll through it on a daily basis doesn't mean that, you know, there's going to be some kind of big love fest between TikTok and Congress going forward.
Yeah, I think that is safe to say. Dan Howley, thanks so much. We are counting down to the closing bell on Wall Street. Dow holding on to gains, but S&P and Nasdaq under pressure. Tech stocks selling off here as the 10-year yield tops 4%. We'll be right back.
All right, just a couple of minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down the market action as we start a new month. Not a great one to close out February.
Could be better. I'm looking at some earnings here, so let's go over those first. Now, Lowe's having its worst day since the last presidential election. Let's actually put a 5-year chart on there. That is after guidance on its first quarter comparable sales disappointed. So the home improvement retailer is saying they will trail their annual forecast of unchanged to down 2%. Wells Fargo is saying on the conference call, saying it didn't go as well as planned, adding all in all, we believe a digestion period is warranted. They're rating the stock an overweight with a price target of $245. Kohl's is also slipping too. So let me find that on our screen right here. And there we go. It's down about 1.8%. That's after reporting what is a surprise loss in the fourth quarter and forecasting weaker than expected 2024 guidance. Vital Knowledge's take saying awful. And with that, the dividend is in question. Well, at least they slashed their inventory. So let's take a look at what's been going on in the general market right here. And we can see it is a mixed market. The Dow is just barely climbed into positive territory. You can see here's the intraday chart. S&P 500 and the Nasdaq are lagging a little bit. And we'll go back here. Let's go over some sector action with 1 minute to go in trading. And here we go. We saw a few sectors in the green, energy notably, followed by materials and industrials. All three of those are outperforming to the downside. Utilities, real estate, and consumer discretionary, those are flagging right now. Those are down 1.5%. If we take a look inside the NASDAQ, looks like we got 30 seconds to go here. Some software names, some chip names standing out, some Chinese names, Pinduoduo, JD.com, 3%, 2% respectively. Intel up about 1.5%. But for the most part, a lot of these tech names taking on the chin. NVIDIA is down 2%. Amazon giving back gains of about 2% as well. If we take a look at some of our leaders here, let's look at the number one spot, KWEB, Chinese internet stock. And here's your closing bell.
All right, well, that ends today's trading session. It looks like the Dow is going to hold on to some gains, up just 5 points today, basically at the flat line. S&P off about 0.5%. The Nasdaq leading to the downside, off just about 0.7%. Some hawkish rhetoric from two Fed officials, adding some of the jitters here to the market today. We saw the 10-year yield topping 4%. In terms of the sector action, real estate, technology, no surprise there. Among the laggards today, consumer discretionary off just over 1%. On the flip side, energy, the leader in today's action, Dave, with it up just about 2%.
Okay, Shauna, thank you. Been a lot of talk of recession as of late, with many economists debating not if, but how and when we should expect an economic downturn. Though what Yahoo Finance senior columnist Rick Newman calls the recession industrial complex may rarely be on the money. He joins us now. Rick, it has been frequent over the past year. Just about every economist has some percentage of a recession. What's their percentage?
Well, we're not in a recession right now, and I was wondering how many predictions of recessions have there been since the last recession? So just to create the context here, the COVID recession started in February 2020. It only lasted 2 months. It was over in April 2020. We had a big rebound after that, and ever since that rebound, we've had economists saying a recession is coming. I mean, it's technically true that a recession is coming because at some point in the future, like over the next 1,000 years, there is going to be another recession. It's just a fact of the business cycle. But there have been so many predictions of recessions that didn't materialize during the last 2 years that I think recession predictions are becoming kind of meaningless. I just went back and looked at all the different places that were predicting recessions in 2021, in 2022. There were always good reasons. The yield curve inverted. The Fed started to raise interest rates. We couldn't possibly continue growing the economy and having more jobs. And yet here we are. The economy continues to grow and job growth is remarkably strong. So my conclusion from all this is, sure, we are going to have a recession sometime, but just be skeptical when you hear people predicting about a recession.
Yeah, and this was an earnings season that started with basically all the big bank CEOs predicting, including Jamie Dimon, some type of mild recession. But Rick, how much does it depend on truly what the definition of a recession is?
the definition of a recession is not as simple as people like to think. So there's this sort of old textbook definition that if you have 2 consecutive quarters of declining GDP growth, then that by definition is a recession. That is not correct. There's a group of economists that calls recession start and end dates, and that is not how they define a recession. They define it as a considerable slowdown in economic activity that lasts for a while and is pretty significant. So there's a lot of wiggle room in that definition of a recession. But some common sense metrics are you cannot really have a recession when you're adding 300,000 new jobs a month. I mean, you really can't have a recession when the unemployment rate is 3.4% at 50-year low as it is now. So if we ever do get a technical recession this year by some measure, and yet we still have a strong job market, then who cares? Great. Let's have more recessions.
Yeah, it's kind of Clinton-esque in terms of depends upon the definition of is, but we won't go down that road too much further. Let's switch over to politics now. CPAC is underway, or Conservative Political Action Committee, and it was always where the future king was anointed for the Republican Party. This year, not entirely clear. You got Trump and Nikki Haley there, Ron DeSantis and everyone else skipping it. Does it still matter?
We'll find out. I mean, we know that the distortions in the Republican Party are so weird that you have to almost be extremist to get nominated in the Republican Party these days. But then that's a problem actually winning in a general election. So, Trump's loss in 2020 demonstrated that, and then Trump endorsed a bunch of very sketchy extremist right-wing candidates in the 22 midterms, and they did very poorly as well. Big indicator here is I think Fox News is not even covering the CPAC conference this year. Certainly not with the sort of breathless coverage they've had in the past, as if this is must-watch TV. And there's another problem, which is that the guy who runs this, his name is Matt Schlapp, he's in some hot water because there's an allegation of sexual impropriety against him. So maybe you've just got maybe you've got a little bit of normalcy trying to creep back into the Republican Party. I think it'll be a long time before we get back to a Reagan-esque Republican Party. But if fewer people are watching the CPAC convention, I don't think anybody's going to mind.
All right, it's interesting that Fox is not covering it. Really surprised. Of course, they've got a few issues. They're called Dominion. About a billion reasons to be concerned. Senior columnist Rick Newman, good to see you, sir. Let's see how stocks closed out the first day of trading in March. It was a bit of an ugly February as all 3 closed down. And here you're seeing the first day in March, the Dow finishes up just barely eking out a green, up 5 points. The S&P drops just marginally, as does the Nasdaq. So we start March out on a mixed note. With us now to talk about it, what lies ahead in studio, Emily Rowland, John Hancock Investment Management Co-Chief Investment Strategist. Nice to see you. Thank you for being here in studio. What is ahead of us? Are you getting a sense of it at all, or are we just going to kind of 2 steps forward, 3 steps back sort of sense of it in the next couple of months?
Yeah, I do think markets are kind of contending with this good news, bad news dynamic that's playing out. Especially in the month of January, we saw this pop in economic data, a little bounce in areas like PMIs, certainly China PMIs this morning, surprising on the upside. I'm sure you've covered that throughout the day today. And inflation prints coming in a little bit hotter. Those 2 things do tend to go hand in hand. Of course, pushing bond yields higher. But again, what's good news for the economy, good news for the labor market, not so great news as it relates to Fed tightening, central bank tightening. Likely they need to do more. Another 50 basis points in rate hikes now being priced into the market. So I don't think investors are quite sure what to do with that.
So just expect volatility in the months ahead?
I think volatility is going to be the name of the game. And what's most notable about this market to us is that it seems like risk assets are acting like there's nothing wrong, pricing in essentially like 0 probability of a recession now. And we're seeing that in terms of the riskier corners of the market, really seeing leadership again. You look at small cap equities having a really great relative month in February. You look at European equities on a tear. These are cyclical higher beta areas that don't usually do that well when that macroeconomic environment is deteriorating. You know, you wake up and there's meme stocks back in the headlines, cryptocurrencies. It's kind of surprising to see that level of risk taking in a pretty precarious economic growth backdrop.
And given something we also talked about earlier is the 10-year hit 4% earlier in the day, gained 50 basis plus points in February. What does that tell you is down the road?
Yeah, I mean, I think that 4% level is kind of a psychological level where we all kind of, I think everybody turned to each other and said, oh my gosh, the 10-year Treasury is at 4%. You know, and again, I think it is evidence that growth is reaccelerating. I think it is a bit of a counter trend bounce in our view in economic growth. And of course, inflation coming in better, China growth certainly playing out here. But when we look down the road and throughout the rest of 2023, you know, all of the indicators that we watch, a deeply inverted yield curve, this morning to the tune of 90 basis points on the 2-10-year. We look at the leading economic indicators, which are signaling a recession's forthcoming at -6% year over year. We're looking at or not necessarily financial conditions, but lending conditions tightening. The consumer is starting to see some cracks in our view. You know, it does look like a recession is going to unfold. In that environment, bond yields fall. They don't go up. So I think eventually you'll see that re-rating in the fixed income market, making this probably an attractive entry point.
Very interesting stuff. All right, can you stick around? We've got some quick breaking news, and then we're going to get right back to you. Shauna's got some breaking news first.
Yeah, let's bring in Salesforce's latest results here. The stock moving higher. Look at that, a pop of just about 10%. The results were pretty impressive here for its most recent quarter. Also, 2024 revenue guidance coming in better than expected. But for its most recent report here, most recent quarter, I should say, adjusted EPS of $1.68. That beat the street's estimates of $1.36. Revenue coming in at $8.38 billion. That is a beat as well. Subscription and support revenue of $7.79 billion. Services revenue of $1.92 billion. I mentioned that 2024 revenue guidance coming in stronger than expected. Salesforce seeing sales here for 2024, $34.5 billion to $34.7 billion. The estimate on the street was just about for $34 billion, so higher guidance there. 2024 adjusted EPS guidance was also stronger than expected. Salesforce also announcing a share buyback program increased to $20 billion there. We're seeing these strong results reflected in the price here after hours, with the stock up just about 10%. Now, we know a lot of the focus on this call is going to be about the latest when it comes to the investment, when it comes to the 5 activist investors that Salesforce is facing, including Elliott Management, also Starboard Value. Earlier today, Yahoo Finance's Brian Sozzi confirming from a source here that Salesforce is in intense talks between the company and Elliott here. No settlement yet, but the board slate from Elliott Management has been proposed. No names have been shared. Talks described as constructive. So, of course, that will be a very popular topic we're expecting here on this call later this afternoon. But for its most recent quarter and the guidance, both of those beating here for Salesforce, and the stock up just about 11%, Dave.
Okay, we'll have analysis of that quarterly report coming up in just a bit. We want to get back to Emily now. We want to play a little game because she is a good sport. We want to get your take on some really hot button issues so far in the markets and play market maker or market breaker. You game?
I've never played it before, but sure.
I don't think anyone's ever played it before.
First time we're all playing.
Okay, that makes me feel better.
So I think we've got a clock. We'll give you 20 seconds, but we're generous. You can blow through the stop sign a little bit. And first is the AI race. Market maker, market breaker.
Okay, so AI, I think, is wildly disinflationary. If you think about the amount of productivity it's going to increase, potential job losses that we see, we are going to go back to a disinflationary state. That's what technology is all about, and I think that creates a bid for longer duration bonds.
All right, what about streaming wars? That's a pretty compelling case there. I liked it. And you
in
got
under
it.
20 seconds.
And you got it in under 20 seconds.
I
am very impressed. I thought the 20 seconds was a little bit optimistic. Okay, let's talk about streaming wars. I'm taking up all this time. What do you think? Market maker or breaker?
So streaming wars, you know, I think that a lot of these companies have put a ton of cash into this. And, you know, we want to actually think about companies that maybe have more durable profitability in this environment. They're not burning cash. They're actually making money. We would rotate into higher quality companies with better balance sheets, more cash on their balance sheets. that's where we would look.
We're going to talk Netflix and what they're doing outside the box in just a bit. Now, that clock, yeah, we got to reset it on each one, but not till she starts talking.
I won already.
Social media crackdowns in the news and a possible TikTok ban.
Yeah,
what's the impact?
This is an interesting one. I'd be curious to see, and I don't have tons of investment implications here, but I wonder if it would potentially expand into these low commission brokerages that really fueled the meme stock mania, the meme stock rally. And we saw, investors that weren't even old enough to purchase alcohol that, really got involved in this. And I think that it's going to be, is there some element of oversight on that regulatory action around the meme stock mania?
We will see. Real quick, Elon Musk here. Lots of directions that you could take this. We're giving you the floor. You could talk Tesla, you could talk Twitter, distraction there, maybe his vision for AI. What do you think?
Yeah, I look at, I don't do a lot of commentary on individual names, but there is a very large EV company out there that's up significantly to start the year, over 70%. And it's trading at a very generous multiple right now. And still, again, in terms of profitability metrics, probably not our favorite place to look right now. Again, want to find companies with more cash, more durable profitability in this type of environment.
Emily Rowland, bravo. Excellent job.
You won, yes.
What do we have for
flying colors. I don't know. We have confetti coming from the ceilings. We've got some work to do. This is our first iteration of the game. So some improvements, but it was fun.
We'll get you your prize next time you come in studio when we find out what it was. Thank you, Emily. We appreciate you playing. All right, coming up, we're diving deeper into Salesforce fourth quarter earnings, from what has shares soaring to what could unfold on the activist investor front. Stay with us. All right, Salesforce fourth quarter earnings beating Wall Street estimates on the top and bottom line. But the big question is, what will the activist investors who have been swarming Salesforce think of these results? One of those investors is Elliott Management. Yahoo Finance's Brian Sozzi says, according to his sources, there have been intense talks between the company and Elliott, that Elliott has proposed a slate of board members. Here's our Ellie Garfinkel with a look at all of these activist investors and who they are.
Activists are circling Salesforce in a situation that's growing increasingly high stakes for CEO Mark Benioff. Right now, Salesforce is facing down 5 activists, all of whom are demanding better expense management from the cloud giant. Here are the 5 activists. 1, we have Third Point, led by billionaire Dan Loeb. He's previously picked a number of high-profile fights, including at Disney and Shell, and Loeb's the latest to join the Salesforce activist fray, revealing his stake back in February. 2 and 3, Value Act and Inclusive Capital. It's worth talking about the two in tandem because they have something in common. Jeff Ubben, who's the founder of both, and they've already notched a win. Mason Morfitt, Value Act CEO currently, and Jeff Ubben's handpicked successor, was already named to a seat on Salesforce's board in January. 4th, there's Starboard Value, which got involved in Salesforce back in October. A source tells Yahoo Finance that Jeff Smith's Starboard is disappointed in the cloud giant's cost management, but isn't pushing for Salesforce to divest any of its mega deals, for example, Slack, which is on the table for other activist investors. 5th, Elliott Management goes for the jugular. The firm, fronted by Jesse Cohn and Paul Singer, often seeks board representation and even has a private equity unit that is known to bid on targeted companies. Sources tell Yahoo Finance that Elliott's stake is worth billions and that they're going to be pushing for succession planning from Salesforce CEO Benioff and better profit margins. So, where does that leave Salesforce investors right now? We asked Wells Fargo analyst Michael Turin.
I think right now, a lot of things are pointing in a favorable direction for investors around where Salesforce ends up over the next 12 months. The longer question is the harder one to answer on what is the 5-year vision.
So this standoff is heating up.
All right, well, Salesforce shares, they are soaring in extended trading. Look at that, up just over 14% right now on the heels of what is looking to be a very solid report here from the company. Salesforce's 4th quarter results topping expectations as well as its full year forecast coming in stronger than expected. For its most recent quarter, we are looking at revenue of $8.38 billion, adjusted EPS of $1.68 here. And again, that strong guidance, one of the big drivers in the after hours action. Let's bring in Rishi Jaluria, RBC Capital Markets software equity analyst. Rishi, great to see you here. So first, just your initial take, your initial reaction to this report.
Yeah, thanks so much for having me. Look, I think this was exactly the quarter that Salesforce needed to put up with all the activist pressures around them. Quarter came in better than I think anyone expected. The revenue guidance for next year, for FY24, not as tough as I think people were expecting. But the big surprise was on the profitability front. I mean, they put up 29% margins this quarter. They're guiding to 27% margins, which they may be able to beat for next year. They increased the size of their share repurchase. I think this quarter was enough to buy Salesforce and Mark Benioff some time.
Let's talk about all those activist investors. We just laid out a piece with more than a handful. Another one joined the fray today, Strive Asset Management, and their co-founder, who, by the way, is a 24 presidential candidate, the founder of Strive, Vivek Ramaswamy. What do you expect to be the impact of this swarm, if you will, of activist investors?
Yeah, look, I think there's maybe different visions that the activists may have, as you outlined right prior to this. But ultimately, I just think it puts more pressure on Salesforce to execute. And they have an outside force watching them, right? So I think it stops them from making dilutive acquisitions, which has been a major pushback from investors to Salesforce. It does bring about additional scrutiny around their costs and kind of discipline around spending. And hopefully, I think it helps Salesforce regain maybe some of their lost mojo, where in the past, this was a very innovative company. I would argue maybe with the space of acquisitions they've been doing, they haven't innovated enough organically or as much as they historically have. And I think that's some pressure activists can bring in is invest more to actually integrate a lot of these acquisitions, integrate the different clouds so that ultimately you have a more integrated company and a better customer experience. And I think everyone benefits that way.
Rishi, how far do you think management has to go in terms of cutting costs to satisfy what the activist investors, what some of them are calling for and saying at this point?
Yeah, I mean, they're guiding to 27% margins for the full year. I think that number needs to go to at least the low 30s with the sort of growth profile that they're talking about for next year. for activists to be happy, right? I think maybe 40% type, Microsoft or Oracle type margins are out of the question in the near term. There's a lot of structural changes you'd have to make to get that sort of margins. But low 30s is where I think they need to get to, and they need to get there fast, right? So if you assume that they're going to do a little bit higher than where they guided to for FY24, could they continue to drive that up, get to 30%, 33, maybe 35% type margins? That's what I think needs to happen in terms of cost cutting and margin expansion to make investors happy.
Interesting piece in the Journal about Mark Benioff, who is going to sit down with Brian Sozzi tomorrow, telling those employees that they were all family before cutting 8,000 jobs, or about 10% of employees. Do you think there are further layoffs coming at Salesforce?
I do. I do believe there are unfortunately going to be more layoffs to come. I mean, if you look at how quickly Salesforce has hired, especially, over the past 3 years, and then benchmark Salesforce's employee efficiency relative to other software companies, there's still, unfortunately, a lot of room to go. And unfortunately, I do think that is going to be more cuts to come, hopefully not as big as round two. Maybe it's more of just underperformers rather than broad-based cuts. But I unfortunately believe there are more job cuts to come.
Rishi, when it comes to the sector, the software names overall, which do you think is best positioned? We're also getting results from Okta this afternoon after the bell. Those results actually look pretty solid. The guidance there, pretty strong. Snowflake, on the other hand, another player in that space, their product revenue guidance missing the street's expectations. How does Salesforce stack up to them, and who's your top pick in that space?
Yeah, I mean, look, Salesforce is, an established company. Remember, a lot of these companies that we're talking about weren't around in 08, 09. Salesforce has weathered 2 recessions, right? They weathered, 2000, 2001, and they weathered 08, 09 as a public company. And you can go back and see how did Mark Benioff react back then. And so this is a battle-tested company. It is a little bit more, because of its size and because of the breadth of its offerings, it is a little bit more, I would say, defensive. If I think about my favorite names in the software sector, I'd give you 2 as a little bit of a cop-out. One to be defensive, which is Viva, which actually just reported after the bell today. They sell software targeted at pharma companies, should be a very defensive name with a lot of growth drivers, just a very high quality, very profitable business. And then when it's, I think, more of a recovery type play, I want to buy HubSpot, which to me is almost the anti-Salesforce, right? It is, in the same space, but very much an organic growth story. And I think a really great business as well. So the 2 names I would buy here, Viva and HubSpot.
And finally, some recent news that Twitter would cut their Salesforce spend 75% from $20 million to $5 million. As we look out into Q1, Q2, do you think we'll hear more cuts, more caution?
Yeah, I mean, unfortunately, you've seen the layoff numbers in tech, right? I think we were at 110,000 tech layoffs in the first 2 months of this year compared to 160,000 in all of last year. So it's clearly accelerating. And for a seat-based model like Salesforce, right, that is a headwind. Now, I think the advantage Salesforce has that a lot of other companies don't is they have so many other products that they can bundle and maybe make up a little bit of that shortfall. That if someone, that's not in cash conservation mode like Twitter is because of their huge debt load, that Salesforce can come back and say, look, you've cut heads by 10%, but let's maybe throw in some Tableau or let's throw in Commerce Cloud to make up that gap so that they don't actually lose revenue in the same way. So I think Twitter is very much an anomaly because of their financial situation. I wouldn't expect to see these sort of headwinds on the rest of Salesforce's business from their customer base because of that bundling strategy.
All right, well, shares surging here after hours. Rishi Jaluria, always great to have you. Thanks so much.
Thanks.
And be sure to tune in tomorrow. Our very own Brian Sozzi will be speaking with Salesforce CEO Mark Benioff about the company's Q4 results, also the pressure that he is facing from activist investors. You won't want to miss that. And coming up next here on Yahoo Finance Live, eggflation is not only affecting consumers at the local grocery stores, but also Dime Brands CEO John Payton will tell us how it's impacting his businesses at IHOP and Applebee's. We've got that coming up for you next.
Shares of Dine Brands Global falling just about 6% today after the parent company of Applebee's and IHOP reported a fourth quarter earnings beat, but revenue and same-store sales missed Wall Street expectations. Let's break down the quarter and what we're seeing from the consumer with Dine Brands CEO John Payton, and Brian Sazi is here with us. We've talked a lot about Sazi. It's nice that we've been quoting you.
I swear I live.
In
it's not. I'm not
program.
AI, buddy.
John, good to see you, sir.
As well, in the green room, I heard 8 references to Sazi,
Right?
but you don't see him.
I'll talk pancakes.
There's just references to him now.
We're forced now to mention him X amount of times per show.
Part of the new contract.
What'd you learn in the quarter, John?
What we learned in the quarter is that our guests and Americans dining out are still looking for experiences, Dave. And so we've seen a lot of the reporting about durable goods. People are not spending necessarily on new pillows or curtains or a new sofa, but the psychological COVID hangover about getting out with friends and family. Restaurants, bars, hotels, cruise ships are doing really well, and both of our brands and our new one, Fuzzy Taco Shop, which you'll ask me about, I hope.
We will.
Further in.
We'll talk tacos.
But both those brands, Applebee's and IHOP, are both value-oriented brands and have spent years building trust with their guests there. And so they performed well, as you could see, with 8 quarters of consecutive comp sales growth for Applebee's and 7 for IHOP.
John, one thing I think I've taken away from this earnings season is that middle America and low-income America is hurting. They've really been hurt by inflation. What are you seeing from some of your restaurants, IHOP and Applebee's in middle America? How are these consumers spending?
Yeah, and that's our focus, right? That's our customer. The 75% of our guests earn less than $75,000 a year, so that is our sweet spot. And what impressed us last year and probably surprised us right throughout the year was the durability and the consistency. So our traffic remained fairly consistent throughout the entire year. Both brands, as we said, post positive comp sales of 5.1 or 5.2 for Applebee's and 5.8 for IHOP year over year. But what we did see is that the guests were managing their average check because they know our menu really well and how to navigate it. So at a time when we were raising price, when our franchisees were raising prices, Brian, they managed to keep the average check steady throughout the year by finding those value-oriented portions of our menu where you can get 2 entrees for the price of X and those sort of things.
So value seekers seeking out your restaurants, do you think they're trading down from a more expensive experience? Let's just say Buffalo Wild Wings. Do you see a consumer that's trading down to an Applebee's and an IHOP?
It's hard to get really specific data on that in our industry, but our sense is that we gained some new customers, and we probably had some of our customers dine with us a little bit less during the year. But all in all, when you look at the comp sales, particularly for the fourth quarter, we were pleased by how steady it was.
It was interesting to see the number as consumers spent at restaurants and bars up 7.2% in January, most since March of 21. How much is due to inflation, in particular food inflation at the grocery store, driving people to go out?
It is true, right? The cost of food and the cost of restaurant prices has risen slower than groceries. I have a personal theory that I don't think that grocery prices are particularly relevant to restaurant prices, because I don't think consumers make a trade-off between a hamburger at a restaurant or a hamburger at home. If they want to eat inexpensively at home, they can have peanut butter and jelly, right? Or they can have a can of tuna fish. So it's really a choice about what changed at COVID is not what you want to eat, it's when and how you want to eat it, right? And so now people say, before they say, I want to have a burger, they say, do I want to eat home? Do I want to eat at a restaurant? Do I want to take out? Do I want to have it delivered? And then when they figure out that, then they say, am I having a burger? Am I having a milkshake? Am I having a pizza? And so we've learned to play in all of those areas because the way in which people make their decisions has changed.
IHOP is just not the destination for pancakes, it's also for eggs. And eggflation has been one of the hottest topics here on Yahoo Finance the past year. How have you managed that? Are you serving omelets with one less egg? How are you dealing with this from a supply chain perspective?
So in terms of reducing our portion sizes, never ever.
So still the same amount of eggs in an omelet?
Still a 3-egg omelet.
Okay, well, how do you pull that off and keep your margins intact?
All right, so let's go backwards to go forward. So first half of last year, inflation of cost of goods into our restaurants, the franchisees' restaurants, was low 20s for both Applebee's and for IHOP. By the fourth quarter, Applebee's was 12% inflation. IHOP was still 19.5, so barely declined because of eggs and also wheat, because of the war and pressure on wheat. When you look at how our franchisees raised prices last year, they raised them 7% or so at Applebee's, 10% at IHOP. So we like what they did strategically in that they took about half the cost of inflation in terms of price, and we thought that was responsible and prudent management of their margins, protecting their margins, but also not pricing themselves out of this value, relationship we have with our customers.
All right, from IHOP to tacos, and there is a segue there because pancake tacos are not bad. I don't know if you guys have ever had them.
Pancake tacos.
Oh yeah.
Okay.
I'm telling you, I'll
I
show
believe
you later.
I hear Sean in the background.
So you may be onto something.
You may have to have a collab.
I may have,
as they call it.
I may have sampled pancake tacos in our test kitchen.
See? Okay. All right. So Fuzzies, is it in that Chipotle category for those unfamiliar, and how significant do you expect it to be driving growth?
Yeah. So what I love about what we all love about Fuzzies is that it's really not in the Chipotle category. So Fuzzies is all about the experience. So when you go into a Fuzzies, it's a place that invites you in and you want to stay. So for example, you're surrounded by huge large screen TVs, great music, really fun design. Every restaurant is built around a bar with really Instagrammable drinks, margaritas that have beer bottles in them. And unlike some of the competitors, you eat on a plate with utensils. So it's a place where you get to the experience of really someplace you want to stay and where you feel welcome to want to stay. So it's a big addition for us.
It's fast casual.
It's fast casual, and it's a great economic model for the franchisees, Dave, because while there's back of house staff, you serve yourself, but you're served on real plates.
Not one we can walk to, is there?
How many of these will you have over the next couple of years?
Our goal is to have many more than we currently have. So I know up here in New York, you may not know the brand well. There's 140 of them. They started in Texas, and they've been growing, sort of north from there. We love the brand because we think it's got great potential to go east. I can't get my directions right on TV. East, west, and north.
We're close.
There's 125 in the pipeline that'll open in the next couple of years, and a big part of our investment thesis is when you plug in Fuzzies to our engine, we can really accelerate their growth, and that was our plan.
Is there one within walking distance?
Of here?
Yeah.
No.
Look out, Taco Bell.
But when you're in Dallas or Denver, take a look for it.
Okay, I'm from Denver. I'll be there soon. John Payton, Dine Brands CEO. Good to have you, sir. Brian Sazzi, always a pleasure. All right, coming up, new data reveals more than half of Black Americans don't have enough money to support them in retirement. Find out about what's being done to close that wealth inequality gap next. With rates rising and stock market and volatility, retirement security is a significant concern for many Americans, especially for women and minorities on the short end of the wage gaps. This prompted TIAA to launch its Retire Inequality movement, which aims to help all people retire comfortably. Joining us now for more on this is TIAA Portfolio Manager Misi Sims. Misi, nice to see you. If you could get to the root of that problem, why is there that enormous gap?
Thanks for having me. There are a number of reasons why, when you dig into the research, why these inequalities exist. I think one of the biggest reasons is just access. Roughly half of Black America, African Americans have access to an employer-sponsored retirement plan. And so if you don't have access to the retirement plan itself, it makes it hard to actually save for retirement. Another reason is just education, financial literacy. Oftentimes, and I'm sure you can appreciate this, if you don't have an understanding of markets and how they function, it can be a scary proposition to invest money there. So we think financial literacy is one, and also access to these types of employer plans relative to other demographics are the two main factors.
Well, Misi, given the fact that so many people do not have access to those types of employer plans, I guess then the next question is, how do we fix this, or how do we see significant improvement on an issue that is so critical and very concerning for millions of Americans?
I think the first thing is care. We all have to take this seriously and consider the fact that it's a part of, you know, our responsibility as a society to help all of us retire with dignity and with security. So this is why we started if we can call it a campaign. I think it's more than just a start and finish type of campaign, though. I think it's a movement, like you said. So talking about it, having a conversation, challenging one another to think of creative ways to support every worker's ability to retire with dignity is a start. And, you know, us partnering with different influencers around in the country and around the world, athletes, artists, to get the message out is the first step.
Yeah, some of those artists, Elena Delle Donne, a tremendous basketball player, Don Staley, legendary figure in hoops, Sedona Prince. How have they helped get the word out there? How much can companies do to help change this gap?
Well, they've gotten involved by having spots during March Madness, for example, or just during the season that they're involved in. I think companies can get more involved, and I think this is a big part of the Secure 2.0. They can get involved by, you know, that legislation was transformative, and I think for three main reasons. One, it allows employers to automatically enroll new employees into the retirement plan. Imagine when you guys just first started working. I can go back to myself. You're trying to find out where the bathroom is, where the paper clips are. You're not thinking about retirement in that moment. So now when you start a job, you're automatically enrolled. Another aspect of the legislation was that catch-up contribution. So if you didn't save rigorously in your 20s or 30s or even 40s, now when you hit a certain age in your 50s, you can start saving more and catching up and making up for some lost time. Another big component to the legislation was that if you weren't saving because you were appropriating funds to pay down student loans, your employer can now match those student loans and put those funds into the employer-sponsored plan. So this touches a large demographic. I think it's very generous and much needed to facilitate this move towards retirement security.
And also, Misi, what is the difference in terms of the gap that we see and how much men typically save for retirement versus women, and why that is so concerning going forward, given the fact that women life expectancy, they have a higher life expectancy than men?
I have 3 daughters and a wife, so this hits home for me. Mm-hmm. So women typically earn, let's say, to keep the numbers nice and round, 80 cents on the dollar compared to men, right? So if you make less, you're more than likely to save less, and therefore you're likely to have less in retirement. And like you mentioned, longevity risk. Women typically live longer than men, so that just exacerbates the problem. And this is exactly why we want to bring more light to this threat, because it's a serious threat and we want to mitigate it, and if not, remove it altogether.
Certainly agree with all that. Misi Sims, great to have you. Thanks so much for joining us. Snowflake is not the only company making moves in after-hours trading. We've got a list for you and some other names that are shaking up Wall Street here in extended trading. We'll be right back. Let's take a look at a couple of names trending after hours. We've got Salesforce, Okta, Snowflake, and Tesla. Let's start off with Okta because that huge move here to the upside. You're looking at gains of just about 11%, 12% right now. A solid report here from the company digging into these numbers. Q1 adjusted EPS beating the street's expectations. Revenue up 33% year over year. That's the forecast, for Q1 adjusted EPS. That beat the street's expectations. Also, their full year forecast for adjusted EPS, that beat Q1 revenue forecast, topping what we were expecting to see. Now, taking a look at what we've seen over the last 3 months, really in gains of just about 6%. Now, over the last year, the stock, though, still trending to the downside pretty severely there. You're looking at losses of just about 61%. All right, let's move on here to Snowflake, another name within the software space. And you're looking at losses of about 6% here after hours. Product revenue guidance missing in terms of guidance for Q1 and for the full year. That, of course, comes as cloud spending has been under pressure. The company, though, announcing a $2 billion stock buyback program over the last 3 months. The stock has been essentially flat, although we have seen some volatility in between here. Over the last year, though, another name that's off just about 41%. Let's take a look at Tesla. Now, this is a stock to watch here in extended trading. The company's investor day getting underway at the top of the hour. We know Tesla is going to focus. They opened talking about that overall push to a sustainable energy economy. One of the talking points here, one of the focuses that we were expecting to hear from Elon Musk, of course, any updates in terms of production, in terms of expansion plans will be of note here for Tesla. The stock's still off just about 29% over the past year, but year to date, we are certainly looking at some strong gains with the stock up about 64%. And rounding it out here with Salesforce, that stock popping here in extended trading, a very solid quarter here from the company. Shares up just about 14%, beating on both the top and bottom lines. Adjusted EPS of $1.68, revenue of $8.38 billion. Also, their 2024 guidance was also stronger than expected, Dave, when you take into account some of the concerns going into this report. And that's not all. Salesforce also upped its share buyback program to $20 billion.
Yeah, that was huge. I'm going to pull out my AirPod because I am listening to Elon Musk in one ear and you in the other. It is still talking about sustainability, if you were wondering. But yes, back to Salesforce. We talked to Rishi Jaluria about this. Does he expect further layoffs? And he said yes, without a doubt. Already laid off 8,000, essentially 10%. And the big question surrounding that is the activist investors. There is we use the word swarm because there's at least a half a dozen. I don't even know if we've counted Dan Loeb in Third Point and Strive Asset Management, who's also entered the fray. Will they be satisfied by a pretty solid report from Salesforce? I don't know, what's your feeling on that? My assumption is not quite when it comes to Elliott Management nominating directors. It still seems like they're going to want to see more, although it was a tremendous report.
It was a tremendous report, better than many were expecting in the street. He really needed that. Benioff really needed to put up a solid report like this, help calm some of the fears out there from shareholders, from investors about what the future of Salesforce would look like. I don't know if the activist investors would necessarily be satisfied with the cuts that have happened so far. I think clearly looking ahead, and we heard this from Rishi, that they need to maybe increase their cuts going forward in order to really get the momentum back within Salesforce's stock. But this is going to be the first time Benioff really comments on the pressure that he is facing from activist investors. He'll be joining Brian Sozzi right here on Yahoo Finance tomorrow discussing all of that. So I think really any inside look on how he's viewing all this will certainly be a focal point of this call. And of course, with the interview with Sozzi tomorrow.
Yeah, and has Benioff seen any other major businesses cut back like Twitter did 75% on their Salesforce spend from 20 to 5 million? Certainly Sozzi will ask him about that as well.
All right, well, coming up next, Stranger Things is returning, but we're not talking about season 5. Find out how fans can watch the show unfold on stage when we come back.
Season 4 of the Netflix hit series Stranger Things has been streamed more than 1 billion hours. And now the streaming giant hopes the theater audience is equally receptive. Netflix announcing today their first live stage production. Stranger Things the play will debut in London later this year. Netflix will also produce a live-action Stranger Things spin-off, and that's not all. TMZ reporting Tom Brady will be one of the first in a Netflix series called The Greatest Roasts of All Time, or GROAT instead of GOAT. Netflix VP of stand-up and comedy formats Robbie Praw saying in a statement, quote, "We can't wait to burn the three-time Super Bowl losing quarterback Tom Brady, who only went back to the NFL in order to delay this roast." So they are doing a lot of things, Shauna, outside the box to make that product stickier than it has been in the past. You got to hand it to them for thinking outside the box, for coloring outside the lines.
Yeah, they certainly are, and a lot of focus on the live content, the push that Netflix has been doing in that area. We've got the live Chris Rock comedy special also coming up this weekend ahead of this year's Oscars. And I bring that up because there are reports out there that Chris Rock is going to talk about his slap from Will Smith that occurred at the Oscars. He's addressed it, although briefly over the last year, so he's expected to talk about it in greater length. And this is going to be a huge test here for Netflix. The company also will be providing a pre and post show programs that are live here to bookend this highly anticipated special. But it makes a lot of sense for Netflix to be pushing into the live streaming. And I think they're going to get a lot of eyeballs on this one.
I would be one of those eyeballs. Chris Rock is hilarious. Can't wait to hear how he addresses the slap, quite frankly. And given that it's live, how much will he push the envelope in terms of language, in terms of calling out Will Smith? And I'm guessing Will Smith is going to be among that audience, right? Because I think, largely speaking, his re-entry, his re-acceptance back into the Oscars and Hollywood community is kind of depending upon how Chris Rock first welcomes him back. So a lot to watch in this special.
That would be interesting. I hadn't thought about that, but it makes a lot of sense.
It'll be a very fascinating night. Can't wait to watch.
Well, we are excited to watch that. Okay. Well, it is closing time here at Yahoo Finance, and here's everything you need to know to end your day. Salesforce's fourth quarter earnings topping the street's expectations. Shares of the company surging after hours after beating those expectations across the board. Also announcing that it was expanding its stock buyback program to $20 billion. Profitability has become a priority here. The slew of activist investors pressuring Salesforce's leadership in recent weeks. So a very solid report there from Salesforce.
All right, now let's turn to Tesla, the electric vehicle maker holding its investor day. Elon Musk and the company starting today's presentation with a look at the big picture for a sustainable future, saying we are headed towards an electric autonomous future. We'll be watching Tesla stock closely tomorrow to see what investors think of the presentation.
And now to the Fed. Two Fed officials, Minneapolis Fed President Neel Kashkari and Atlanta Fed President Raphael Bostic, both saying more aggressive rate hikes may be necessary. Kashkari saying that he is remaining, quote, open-minded about whether the Fed should raise rates by 25 or 50 basis points at its next meeting, while Bostic wrote that he thinks the Fed funds rate needs to be raised to between 5 and 5.25% and left there well into 2024.
Very interesting comments out of the Fed today. That will do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 o'clock Eastern Time, for all your coverage leading up to and after the closing bell.